This is Tom Kozlik, the head of research and analytics at HilltopSecurities. Thank you, everyone, for joining us today. This is the 11th episode of our Politics and Finance Hilltop Securities podcast for 2021. During these discussions, we consider topics that intersect the worlds of politics and finance at the federal, the state, and the local levels in the United States. Often, we concentrate on issues related to public finance and the municipal bond market. Several times this year already, during this series, we zeroed in on ESG, or environmental, social, and governance themes. ESG has become increasingly important to investors, issuers, regulators, and we will consider some of those themes today for sure. We're also going to take a little bit of a rear view mirror look at COVID while trying to assess and figure out what some of the lessons have been that we've learned in 2020 and early 2021. But also the spread of the Delta variant continues to threaten, and we're going to get into our guests' view about what may be in store as a result of the increase of infection from the Delta variant. So today we have the head of U.S. Public Finance from Fitch Ratings, Arlene Bohner, with us. Thanks for joining us today, Arlene.
Thank you for having me, Tom.
Arlene was named the head of U.S. Public Finance just as the COVID-19 crisis was starting to unfold at the beginning of 2020. So I'd have to imagine there was some trial by fire there at the beginning. Is that right, Arlene?
That sounds about right, yes.
Yeah, I'd have to imagine. So Arlene has been at Fitch for about the last 10 years in the public finance group before being named the head of U.S. Public Finance. She worked as a municipal credit consultant before that. And before that, she was a ratings analyst at Moody's, and she worked at the City of Philadelphia's Streets Department. I also want to mention that Arlene is a Fells Masters of Government Administration grad. That's the MGA program at the University of Pennsylvania. Again, Arlene, thank you very much for joining us today. We really appreciate it.
Happy to be here.
So events that were directly impacting public finance at the beginning of last year, in say February or March, they were coming at a furious pace. How is it that you and your leadership team were able to manage that process?
That's a great question because typically U.S. public finance is a very, very stable sector where we always try to read through economic cycles. But the pandemic was a massive credit event for our issuers that really triggered a cycle that was like no other we had seen. And at the time, thinking back, we really didn't know the extent to which the federal government was going to intervene. And I can remember bringing my team together in those early days and reinforcing to them that this is a situation where they won't be able to look to the past for precedent. There is no elder statesman analyst that they can turn to and ask, hey, how did this pan out in the pandemic of 75? They were going to have to draw on their own experience and their own analytical judgment to determine, which credits were at risk and how much were they at risk. And luckily, we have a very experienced and long tenured team, and they were up to the task.
So does that mean at the very beginning stages, you were with your leadership team trying to differentiate between, for example, maybe some of the events that we saw, 10-ish years ago, leading up and during the global financial crisis?
Can you repeat that question? I'm sorry.
So maybe put another way. Do you think that when you were talking to your leadership team at the beginning of last year, were there some similarities or differences between what was experienced during the global financial crisis?
I think there were, at the time, we thought there were more differences than there were similarities. We needed new ways to be able to look at our credits, assess our portfolio, and to see where the risk lie. Many of our traditional metrics that we look to weren't really helping us. They weren't telling us about what was going on at that time. So we needed fresher data points that were more relevant to what was going on that minute. We could see that the pandemic was affecting different credits in different ways. We needed tools that would tell us who was the hardest hit and how will we know when they've hit the trough and are into recovery. How will we know when we've bottomed out? So we started looking at some new data points. We looked at a lot of the high frequency data, things like subway ridership, Google mobility data, sales tax collections, real estate trends. We looked at the monthly state tax revenue breakouts from the Urban Institute. But I think the tool that was perhaps the most enlightening for us was a tool that we developed during the pandemic, our monthly labor trackers, where we do a deep dive into the employment statistics every month. And those labor trackers really helped us to see who was the most and least affected by COVID. And then we graph that against who has had the slowest or the fastest recovery in employment. So that really helps us to see where people are in their cycle. And it also helps us to identify which areas have lost labor market participants, and helps us to think through what that means for the trajectory of their economy going forward.
For the most part, there wasn't really a lot of negative ratings activity in 2020 and at the beginning of 2021. Please correct me if I'm wrong. I was wondering if you could describe how you and your sector heads approached the landscape specifically, and maybe explain why that there were, probably a lower number of ratings activity that occurred than I think what many were expecting.
Yes, I think you're right. In retrospect, I think it's even surprising to us that there wasn't more rating activity. We do take a through the cycle approach to ratings, but this cycle was not like any cycle we had seen before. And it's also, the stresses that our issuers were coming under were nothing like the stresses that we put them through according to our criteria. So there were definitely extraordinary circumstances to be evaluated. We could see that the pandemic was affecting different credits in different ways, and the damage was uneven. So we didn't want to take a blanket approach because we didn't think that made sense. So we tried to have a more surgical approach where we really dug in and identified which of our credits were most at risk and focus our rating actions there. And we did look at each and every one of the credits in our portfolio, but we tried to look first at the ones where we thought, okay, for instance, dedicated tax bonds or mass transit credits. These are clearly at extraordinary risk in the near term, and so we tried to look at those first. So we looked at every one of them, and the vast majority we were able to affirm those ratings because we thought that they would be able to make it through the storm and return to a credit profile consistent with their rating within the next 3 years or so. So we relied heavily on our scenario analysis to help us make that assessment. A lot of the actions that we did take were outlook changes, and those tended to be credits where we thought they might not regain that level of resilience back within, say, 3 to 5 years. And if we thought it was likely that the credit would not be able to get there within 3 to 5 years, those were the credits that we downgraded. So, I mean, overall, the sector lived up to its reputation for overall credit stability, although I will say some, at least some credit for that is owed to the federal government with the extraordinary amount of stimulus money that was poured into the sector.
As you're talking about this process, I'm being reminded of something that I've mentioned several times over the last month or so as I've talked more about monetary policy, where the Fed chair back in June was talking about the fact that we needed to be humble about the data. And it's not just what the data, what the expected data is, but that we need to wait and see what the data actually is. And it sounds like that's more or less what it is that was your goal from the beginning and what it is that you continue to do.
I think that's right. And, as I mentioned before, the traditional sources of data weren't as helpful in that
Mhm.
regard. So we really did have to seek out new sources of data and new ways of analyzing up to the minute data, which, high frequency data has its own issues and can be somewhat problematic. So we had to really work at how to use that tool without falling prey to some of the drawbacks.
And I remember talking to you and some of your sector heads and many of the analysts, at the beginning of when many of these events were kind of unfolding at the beginning of last year, and you were all signed on to this approach. And I'd have to imagine that there might have been some criticism that you were receiving at different times during the year. But honestly, I think that, the way that you explained what it is that your approach was at the beginning, I mean, you did an excellent job of describing it to me, and I'm guessing that you did a similar job describing it to others. And I know that you described this in other published pieces, but I think that that was very important. It was very important uh, to describe that approach so folks weren't caught off guard, frankly, one way or the other. So I really appreciated that. So thank you very much.
Well, thank you.
Hmm.
I'm glad it was clear because it can be difficult to communicate in those circumstances. And I think what was really helpful was the approach that Fitch took company wide, publishing our baseline and downside coronavirus scenarios so that across the company, everyone was speaking the same language about, what we meant about things and at what point we would be thinking about outlook changes versus downgrades and what the recovery timeline was. So that helped our analytical team as well.
I'm glad that you mentioned those because there were several times during the conversations that I had with not just the sector heads, but especially the analysts themselves. They referred to that analysis several times, and I agree. It absolutely made it so there was I don't know if calling it a base case is the best way to describe it, but it seemed as though there was a consistent base case that everyone signed on to.
Mm-hmm.
So now the Delta variant is threatening. Can you share with us what it is that we might expect from Fitch in the near term related to the Delta variant and maybe even potentially other variants?
Sure. I think as much as we all wanted to believe that the pandemic was ending, Delta has shown us that it's not over yet. There are still pockets of risk out there that we have to be vigilant about. States and local governments will be at some risk of stalling or reversing the economic recoveries that we've been seeing. But I don't know that that's where the most risk is because at this point, most of those credits I think are well positioned to withstand, imposition of temporary mitigation measures if it should come to that. Um, Healthcare is a sector where I think we could see some material risk playing out. And, as cases surge again, elective procedure volume, which is the highest margin business for hospitals, will naturally be limited, and then expense pressures are going to stay high. That's going to continue to be an issue for our not-for-profit hospitals. They already have high levels of debt, and that's going to continue to be a factor for them. Many hospitals drew on lines of credit or issued taxable debt to beef up their liquidity at the beginning of the pandemic. And those borrowings are, now on their balance sheet, and we think that a significant amount of that debt is going to remain on their balance sheet. And one of the concerns that we heard a lot about from our issuers in 2020, and now we're starting to hear more about it now as Delta variant is surging, has been the amount of staff resignations. A lot of staff are leaving due to burnout or what's called moral injury, which is the extraordinary psychological stress on frontline healthcare workers that's brought on by working in a pandemic. And then you also have the need for staff to be offline if they've been exposed, if they get sick, if they get many of them are vaccinated, but as we've seen, there are breakthrough cases happening. All of this has led to higher costs, higher staffing costs for hospitals hard hit by the virus. They've had to pay a premium for staffing. They've had to hire temporary workers at very high cost. So hospitals that are in hotspot zones with respect to Delta, they are not out of the woods yet. And I think we're going to, instead of maybe not broad pressure on the entire sector, but pockets where these Delta cases are coming up are going to continue to put pressure on the hospitals in those areas.
Yeah, just before we, over the last week or so, before we started recording, there have been in some states hospital systems where I've seen, whether it be, as you mentioned, limiting or eliminating other kind of non-COVID procedures. That's already been, I guess I'm going to say happening, but re-happening, because that's something that was happening in the spring and the beginning of the summer of last year.
Right.
So let's switch gears and discuss what it is that Fitch is, or in some cases, maybe not doing where ESG themes are concerned. I know that Fitch rolled out the relevance scores back in the summer of 2019. I'm right now looking at a May 2021 report titled Where ESG Matters for U.S. Public Finance that gives us some more detail. I was wondering if you could describe for the folks who are listening how it is that Fitch incorporates ESG generally, but then also explain what we need to know about your relevance scores and how they are incorporated or how they influence the U.S. public finance ratings.
Sure. So yes, as you mentioned, Tom, in May of 2019, Fitch began adding environmental, social, and governance disclosure to our U.S. public finance ratings. We do that because ESG risks are often very different from credit risks, and they only impact credit risk profiles a small percentage of the time. But today's investors are looking for clarity on exactly when and how that occurs. So we publish ESG scores with our ratings that show where and how much our existing ratings already include factors that have an ESG angle to them. So those ESG relevance scores encompass 15 separate ESG factors, 5 each for environmental, social, and governance, and each one of those is individually scored from 1 to 5. And those 15 ESG factors are informed by work that's been done by the Sustainability Accounting Standards Board, or SASB, the United Nations Principles for Responsible Investing, or UNPRI, and they incorporate World Bank governance indicators as well. So that's scaling of 1 to 5. 1 is when the risk is irrelevant to the sector. 2 would be for where it's largely irrelevant to that issuer. 3 is for when the ESG factor is relevant to an issuer, but it's being managed such that it doesn't have any credit impact right now. And that's the bulk of the scores that we have. 4 is for when a risk with ESG roots is starting to affect a rating discussion. And 5 is for those cases where a rating action is specifically driven by an ESG factor. So, just keep in mind these are observations on existing ratings. They are not scores of ESG performance. They don't change the way that we assign our credit ratings or what level of credit rating we assign, but they do provide transparency to investors on where ESG risks are also relevant to the credit profile.
So you mentioned that they only really impact the ratings a small amount of time. I was wondering if you could give us an idea of the actual numbers and how often it is that they do impact the ratings.
So overall, for the entirety of U.S. public finance, it's about 7% of ratings. So it's it's a pretty small number. That varies by sector. So we have some sectors where it's much, much higher, and some sectors where it's much, much lower. One where I think it's pretty extraordinarily higher is our community development and social lending sector, which used to be called housing. And in that sector, we have a lot of positive ESG scores. So many of our ESG relevant scores relate to negative credit factors. In community development, social lending, we have a fair amount of positive ESG scores where these ESG factors are factors that are putting positive pressure on ratings. So I think about 65% of the ratings in that sector have elevated ESG relevance scores.
The last thing that I'm going to ask about, Arlene, is whether or not there are kind of high profile, if there's been some high profile ratings activity recently. And what I'm thinking about when I ask that question is if there have been incidents like the February of 2021 Texas freeze that I experienced, for example, because I live down in outside of Dallas now. If there are events like that or other things like that that have been a little more high profile that you could talk about.
Yeah, I think that one is probably the one that really springs to mind for me, because it affected so many of our issuers, our public power issuers in Texas. So, as you know, that there were a lot of ratings in public power ratings in Texas that were placed on negative watch. And also, many of those watches ended up being resolved. There are still a couple of watches still outstanding, but the vast majority of them were resolved. Many of them resulted in downgrades. They all still are on either negative watch or negative outlook, with the exception of one, which is at stable outlook. But when we took those actions, when we placed them on rating watch negative, we raised the ESG relevance score for exposure to environmental impacts, which is one of the 5 sub-factors under environmental.
Mhm.
Those were raised to 4 when the rating watch went on. And then for those credits that experienced rating downgrades, that particular ESG relevance score was then elevated to 5, indicating that
High
this
impact.
issue directly affected the downgrade action.
Mhm. That's and that I'm looking at your scoring definitions, and that's that 5 is to being, as you're noting, described as being highly relevant to that credit. So that makes sense. And I remember from the beginning of when this was going on in February, uh, quoting and talking to folks about the actions um, that Fitch was taking. So thanks very much for that. And I also want to thank you for joining us today, Arlene. We're very pleased that you could make time for us.
Well, thank you very much for having me. It's been my pleasure.
And I'd also like to thank those who tuned in and downloaded our recording today. Thanks very much for listening. And for those interested, you can see the recent Hilltop Securities economic and municipal commentary and listen to our podcasts by going to hilltopsecurities.com/commentary. And you can follow me on Twitter and LinkedIn. Thanks again, everyone. We look forward to bringing you more color in the future related to topics that intersect both the worlds of politics, finance, and public finance. This has been Tom Kozlik from Hilltop Securities.